Good morning. This unusual Friday morning meeting. So welcome here. I'll take apologies first, and we have apologies from Councillor Austin White and Councillor Linda Marshall. Are there any more?
And yes, this morning we've received apologies from Steve Ragg.
Thank you very much. So, urgent items, announcements, none I assume. Item to consider in the absence of public and press? No. Declarations of interest by members? Nobody interested. Right. Reports from and questions by members? I'll just run through the agenda. Questions from members of the public? No. Minutes and actions of the previous meeting? Can we agree that the minutes are a true and accurate record?
Yes.
Please note the updates on open and closed actions provided. Are there any questions on them? No. Right. Okay, on to substantive item. Item 8, audit of the statement of accounts 23-24. Simon Tompkins, please.
Thank you, Chair. So this is the final stage of the audit process that we've now reached. So it's Audit Committee's responsibility to consider the findings from the audit, and James is here and he'll go through the detail of the auditor's report, but I'll just sort of highlight one or two things before I pass it over to him. So the Audit Committee being asked to consider the auditor's report and then to endorse the statement of accounts so that they can go forward to MCA board for formal approval on the 28th of January. And the reason why this meeting's had to be called is to fit in with the new timetable that's been sort of set as part of the national strategy for resetting local government, which is, everybody's aware, is sort of fallen into a major backlog. So the timetable now is that the 23-24 accounts have to be concluded by the end of February, which is why this meeting's had to be called, in order they can then go forward to MCA board on the 28th of January and achieve that deadline. In terms of its sort of key messages from the auditor's report, things sort of pulled out are that overall it's very positive in that, you know, the changes and audit adjustments that have been made have been largely presentational. There has been one change that affects the balance sheet, but that's in relation to pensions, and that's just a technical accounting adjustment and doesn't impact on the resources at the disposal of the authority to deliver its budget and capital investment programme. There's also been a sort of positive conclusion in terms of the value for money arrangements as well. So that's the other aspect that's covered off by external audit. And so they've concluded that there are, you know, sort of good arrangements in place to secure value for money. So those sort of very positive messages coming out of the report. In terms of the detail, there's been a few changes made to the disclosures. I'm not going to sort of run through. They're highlighted in the cover report, but I wasn't proposing to go through those in any detail. And it's as well also just to make you aware that although the audit's substantially complete, there are still some sort of ongoing final review queries through the review process. So James will probably raise those in his presentation, but there's just a couple of issues that just want to bring to your attention. There's an issue around the disclosure of the pensions asset in the balance sheet for the prior year, which isn't technically classified in the right position within the balance sheet, but we're not having to make an adjustment for that. The other thing is on the annual governance statement. I know Dave's got one or two points he wants to raise on that more generally, but on the annual governance statement, KPMG have just asked if we can consider updating the section of the annual governance statement that deals with external audit to reflect the changes that have happened over the last 6 months since it was presented to Audit Committee and approved by the MCA board back in June. So nothing substantive, but it's just bringing it up to date factually for what's happened since. And the only other thing probably just want to bring to your attention is the draft audit opinion on the 23-24 accounts. So the draft audit opinion is a disclaimer, which means that KPMG are unable to express an opinion on the accounts, and that is a legacy of where we got to on the 22-23 accounts. So if members recall, we've only just signed off the 22-23 accounts. The previous auditors didn't conduct an audit of the financial statements, which meant that KPMG inherited the audit for 23-24 with no independent assurance on opening balances or on prior year comparatives. So which is why they've been, although they've done a very extensive and thorough audit of 23-24's accounts, the legacy of the inherited means that they're unable to give an opinion on 23-24. So the draft audit opinion is also going to be a disclaimer for 23-24. But within, as part of the national proposals to rebuild assurance over a period of time, there's a pathway to getting back to a position where hopefully in the near future KPMG will be in a position where they're able to give a clean audit opinion on future years' accounts. So I think that's all really I wanted to draw to your attention. So if nobody's got any questions, I'll just hand it over to James, and he can talk through the detail of the auditor's report.
Shall I bob in at this stage? Just 2 or 3 bits and bobs at this point. I know this is sort of an interim meeting, so I'm assuming that bobbing back an item was the action log on page 31 is a series of actions with no updates. I'm guessing that's just because we're not actually at the proper meeting cycle, so we're going to get them next time. Yeah, I thought that was the case. And then the issue I just had a quick chat with Simon and the auditors on before the meeting. There's not a lot in the PBSE report reflecting what's happened at post-balance sheet event, but any civilians that are watching this note reflecting the action, the things that the police with their debt position and MRP. I think both of you are happy that there doesn't need to be anything in there, but I thought I should raise that sort of formally at the meeting for you to say you're happy that that's not the case. And similarly, you're happy that there's nothing needs adding to the narrative report, where there's a page 68 reference to medium-term financial challenges, which it certainly is, but I don't think there's a reference to it in there. So just have a think before we finalise in case anything needs to go in either of those.
Okay.
Yeah.
Thank you, Chair. A couple of quick questions from me, please. Were there any objections to the accounts?
No, there weren't.
Thank you, Simon. And secondly, in terms of presentational issues, we refer throughout to Doncaster Metropolitan Borough Council. Should that now be City of Doncaster Council?
Yes, you should. Yeah.
So we'll make those.
Or was it still at the time Doncaster Met?
Just checked on the internet, and it became City on the 9th of November 22. Now, I don't know when the council formally changed its name, but it sounds like for 23-24 it might well have been City of Doncaster, and we just need to, I know it's a big change, but we need to get it right.
The point for clarification? No. Over to you.
Thanks, Chair. So Simon's covered off a great deal of the substantive elements of the report, but I will go over it in a high-level detail. So this is our Audit Highlights Memorandum, so also known as our ISA 260 report, that summarises our findings and associated results and conclusions associated with the 23-24 financial statements audit. So the report really kicks off in detail on pages 4 and 5, where we provide an insight into our audit conclusion, which is a disclaimed audit opinion, as Simon pointed out. in the context of the statutory backstop. So whilst this section covers off the reset element of the local audit reset and recovery implementation guidance, page 22 and 23 of the document considers more the recovery stage of the audit process, as Simon has alluded to, in terms of how we have already started to and how we will continue to build back assurance over the next few years to get to that clean audit opinion. Page 6 of our report, page 184 of the pack, provides a useful one-stop dashboard in terms of the key reportable issues that we have identified through our audit. As Simon has alluded to, I think this is a very, very positive outcome in terms of the volume and the nature of the things that we have had to report within our within this document. First-year audits are historically difficult in normal circumstances, never mind when you put it in the context of the general LG backstop, notwithstanding also all the strategic activities that management have had to deal with, as well as the business as usual aspects, and also the completion of the 22-23 audit. And I can say that through my own personal experience of doing first-year audits within the local government sector, and also my colleagues, the majority of the reports aren't this clean. And so there is a great deal of assurance that can be taken within this report. And as Simon has alluded to, I don't want this page to be indicative of the idea that we haven't carried out an extensive and thorough audit that's been grounded in challenge and professional scepticism. I'm sure management can agree to how detailed the audit process has been, and also given the timelines in terms of how long it's taken to get here, it's sort of indicative of the level of work that's going on. So in terms of the outstanding matters, as we've said, we're really at the end stages of the audit. All the substantive work has been finished. We're now in the process of making sure everything ties through in terms of dotting the I's and crossing the T's with regards to disclosures, and we've had good back and forth with Simon around just making sure everything is exactly how we would expect it to be within there. As Simon's also pointed out, subsequent to drafting this report, we did complete our pensions disclosure review, which is listed as one of the bullet points there. As part of that, we did identify the issue in the prior year balance, where, as you can see on the face of the balance sheet, within the liability section, there is a net pension asset noted. So it looks a bit at odds having an asset in a liability section of a report, and really, technically speaking, that should be a non-current asset. But whilst the material figure from a qualitative point of view, that's not deemed material enough to suggest a prior year adjustment is required. So we're happy that that stays where it is for the purposes of this audit. If we go through the sort of this page, but details with the more detailed discussions later in the report, if we look at the significant audit risks and other areas of audit focus that we've covered, we've got no reportable findings in there in terms of uncorrected audit misstatements, corrected audit misstatements, or significant control deficiencies, which is a really positive place to be in. It is worth noting with regards to the infrastructure asset audit area of audit focus. As we've gone through that process, we've understood that actually this technically should be considered a change in accounting policy and therefore applied retrospectively. However, what we've been through with management is an understanding that from a qualitative point of view, again, this isn't material and therefore doesn't need to be applied retrospectively. We've ensured that management have included a substantial note within the financial statements to explain that point and to make it really clear to the readers why that decision has been taken, and we're happy with that disclosure as it stands. That's the only uncorrected audit misstatement, and technically speaking, it's actually not necessarily an uncorrected audit misstatement. It's just drawing your attention to the fact that there is a technicality with regard to that, but actually we wouldn't expect that to be changed due to the level of immateriality from a qualitative point of view. In terms of the corrected audit misstatements, Simon's already touched on the two financial ones. As he said, one is merely a presentational issue, and the other is a technical accounting adjustment with regard to the pensions. However, both have been corrected, and there's been a number of presentational disclosures that have also been updated as we've gone through the audit process, which is to be expected, really, in terms of the level of detail and contents within the report itself. We have identified three control points. None of these are significant control deficiencies and therefore don't need to be commented on within your narrative report. A couple of the second and third one are really areas that we've identified throughout the audit. The one in terms of the double payments is a once-off, but we need to report it in terms of a finding. The IFRS 16 point is important to note in terms of the work that needs to be done going forward to make sure that the accounts are in a compliant process. And then we've got the recommendation there that you'll probably see in most ISA 260s for bodies as part of a first year process, where I suppose there's a quite significant learning curve change in auditors in terms of the level of expectations, the detail that we require compared to other auditors. And what we've done is we've had a really good relationship with management where we've been able to discuss openly and honestly in terms of what our expectations are, set relevant timelines, and get to an agreement in terms of what's needed and when we can get there. And I think that's how we've ended up in such a positive place ahead of the backstop date. Also within the report, you'll see there the summary conclusion on the value for money arrangements, which are clean and no significant weaknesses have been identified. And really then the rest of the report goes on to make some mandatory communications that we're required to make at this stage of the audit in terms of our independence, the work that we've done over the front end of the accounts, and other issues with regards to our fee. And we've also added a couple of additional appendices for information to help bring to life some of the audit and standard concepts that have been implicated for this year. So I'm happy to stop there and take any questions on the report at this stage before we move on.
Yeah, thank you very much for this, and thanks to officers for getting everything completed in what's been a difficult year for auditors and officers. One really simple one. As usual, we're seeing much higher fees levied than in the letters, in the original fee scale rather. Are officers happy that the amount of fee being levied represents at least value for money for what we're getting given the revised requirements? So we just have a quick discussion on that. I notice there's a comment on documentation and management overview of journals. Could we have officers' thoughts on that, please? And it's in there, but it's not noted as a control on page 224. It's not noted as a control deficiency on page 209. So I assume we're thinking it's not major enough to warrant there. So that's one for James. Page 227 has some explanation on the surplus on provision of services of 30 million due to additional treasury management income, fair enough, and slippage in the delivery of capital projects. I just wouldn't mind 2 seconds on why slippage on delivery of capital causes an extra revenue surplus. It might be obviously me being stupid somewhere, but I can see it might reduce your capital charges going forward, but be a lot to do in the year. And final one, page 223, there's 5.2 million of loans to local entities written off. It says lessons learned have been carried out, but are there any officer comments on what's happened there? That's quite a lot of money to be writing off. That's perhaps one for Gareth or Mike rather than for you. So and then I'll shut up.
I think I'm trying to remember all those questions,
Sorry,
David. Hopefully someone else has written them. But on the first question, I'll bring on fees. I'll bring Gareth in on this particular point. Gareth.
Thank you. And my apologies that I can't be with you today. Unfortunately, some urgent sort of circumstances locally for me to deal with. Just on fees, I think the starting point would just be to say I feel like we get much better value for money from our current auditors than we did from our past auditors. So that's our starting point. I actually feel like we're getting something out of this engagement. So my thanks to James and his team for the work they've done over the course of the year. I think the broader point, Dave, is more significant, and this cuts to the consultation on local audit that will be launched soon, and that's whether the totality of what we are paying for that the auditors are asked to deliver. So I don't have a problem with that, but what the end product is, does that add an awful lot of value? And I think that's a question about whether the accounts are a consumable product for the local elector to understand what we are doing and test whether that is appropriate. And my view is that the product that is in front of you today is not consumable for 99.9999% of the electorate. there's probably very few people in this country who could pick up our accounts and form a view about what we are doing and whether that represents value for money. Now, we clearly have KPMG's opinion and the work that they've done, which provides me with lots of comfort that there are no gremlins lurking around in our books. But I think we spend an awful lot of time and incur an awful lot of cost to deliver a product that doesn't add a huge amount of value to the person on the street. Now, that is a systemic issue that government will be consulting on. It's not a KPMG issue. As I've said, I'm really pleased with our relationship with KPMG and the level of rigor they've brought to this exercise. But more generally, I think there is a challenge in the overall audit landscape that needs probably addressing.
So I'd agree with that, but every time we get a new consultation on it, they just suggest adding more things to do rather than taking things off, and they are very, very difficult to follow, the accounts. I absolutely agree.
Yeah, I think the pendulum has swung far too far into a technical space, and that's impacted on the usability of the product that we've now got. Do you want me to pick up some of the other questions? I think there was a point raised about capital program slippage and the impact on revenue surplus. Was that right, Dave?
That's entirely right, Gareth.
Yeah. So the issue here is that our capital program delivery is markedly improved over the last few years. We've put an awful lot of effort into speeding up the pace at which we can support partners to get delivery underway, and that meant that we hit our highest ever levels of capital expenditure last year, and we will beat that this year if forecasts come through. What we're still seeing, though, is that we've still got marginal slippage, and that means we've got more cash held on deposit. That cash is being held on deposit at much higher interest rates than we've seen in the past, and that is meaning that we're accruing what we call treasury management investment income at a far greater extent than we forecast in the budget. So just to give you a flavour, for the current financial year, I think we forecast around £10 million of surplus to be generated. We're on course to generate about 20 million this year. And that's, again, we've got higher cash balances than we're anticipating. Capital program slippage, plus government have been very generous in sending us cash sooner than we were expecting. And that's being held on deposit at higher interest rates than we were expecting. So you're probably all aware, inflation has been higher over the course of the year. That's meant Bank of England have kept interest rates at a higher level. That's a problem in some ways for us generally across the group, because it means prices are higher across supplies and services. It means the wage bill is higher than we might otherwise expect in terms of national pay agreements. It means that when we come to take borrowing, which we will need to do for the police fund in the forthcoming year, it will be higher than we anticipated. But it does mean that the income that we can generate from cash held on deposit is higher. And I think that's what that's driving at there. Does that make sense?
It does, but a surplus and provision of services of 30.6 million can't be made on interest on cash balances of 136 million. There must have been an underlying planned surplus there somewhere. I get that, extra cash means extra treasury management income, absolutely right. But the surplus you're reporting is 30 mil, so there must have been an underlying expected surplus in there, and it's giving you a bit more, surely. You're not making 30 million more worth of interest on your cash balances. You need £1 billion worth of cash balances to be doing that.
We had roughly £500 million on deposit over the course of the year. So I'm not quite sure which number you're looking at, but I'm sure the team in the room can give you the number of cash held on deposit. Now that will be probably split between short and long-term investments and the cash at bank on the front of the balance sheet. That number should be roughly £500 million, guys. I'm looking at Simon and Owen.
Yes, that's right.
Yeah. And so we generated around 20 million last year, Simon,
That's
against
right.
a forecast target of 3. So there should be at least 17 million surplus in that number.
If I just step in, I think the vast majority, as Gareth explained, of that surplus will be relating to, treasury management income that we've managed to realise. I think the rest might just be a technical accounting issue where we've got capital grant that we haven't applied, that we've received in year, that goes in, gets fed into your surplus or deficit on provision of services, but there's no corresponding expenditure. So we've just put that money into capital grant and applied. So it may be that's giving rise to the 30 million in total.
And that would be gain share capital, Simon, which thing is comes with no conditions. So the accounting requires us to push it through that line. That's around £18 million a year, and that's capital that we won't have spent in year, but intend to spend in future years.
Yeah.
So the 18 plus the 13 gets you roughly that space. Yeah.
I think so. But I'll double check, Dave, if you want. And find out.
Thanks. Sorry, I think what's fooling me is on page 227. There's a reference to a year-end cash balance of 136 mil, which is clearly less than the £500 million. But I get the point that oddly nowadays you can get capital grant, but it's still a revenue gain, which is I think all of us find a bit difficult because it used to be entirely capital until about 10 or 15 years ago when they changed the rules on it. So it's additional capital grants that's been cycled into, that's been applied and so cycled into revenue and some additional interest. But yeah, that line has a figure of 136.0 million cash balance. So I don't know whether that's not right or whether it's part of the cash balances and not all of it.
So you've got some of the money is disclosed as a cash balance. So you've got cash and cash equivalents, which will be where all the money market funds sit and call accounts. But the investments with local authority fixed term deposits, they're actually shown as short term investments.
Right.
So if you put the two together, that's where you come back to the 500 million. But that figure probably is just the cash and cash equivalents element only.
On your first point, Gareth, the presentation to the public, I think that's worthy of a discussion at some future date, perhaps even with the Mayor.
Yeah, I think there was an intention for. I joined a call yesterday, chief finance officers across the country with officials from Ministry, Housing, Communities, Local Government, who were outlining their proposals. And I think there will be a larger consultation exercise to come on this. Lots of people making similar points to myself that, we're asking Audit to audit a set of accounts to a prescribed standard that incurs a lot of time and effort, but ultimately, what assurance does it give to the member of the public? And I think that's a matter for debate. It's becoming an increasingly technical exercise that very few people actually understand.
Are there any? Yes.
Thanks, Chair. Just following up Dave's question on the journal vouchers, I think, which I don't think we've covered yet. Were the control issues related to around the level of detail, or is there something else?
I'll come in first, Paul. In terms of this journals point, we're required under the auditing standards to consider the design and implementation of controls that address the significant risk. So in this case, management override of controls, one of the key areas is around journals. So we need to ensure that there's appropriate segregation of duties in place around the preparation and review of journals. What you'll see in 99.9% of these documents for private and public sector organisations is that comment around journals, so it is not a MCA specific issue. The reason for this is that the audit and the standards set quite a high bar in terms of what it expects. So from an MCA point of view, the initial issue is the fact that whilst we're happy anecdotally that the reviews are taking place, the level of documentation to demonstrate the sufficiency and appropriateness of those reviews in terms of you can get a journal that's one line, but has the person got out the supporting evidence, looked at the double entry, signed it off, added comments, that type of things. Now, given the number of journals that are posted, for individuals to do that in terms of time, reward, effort from that point of view, it doesn't really weigh up. So it's unlikely any organisation would actually be able to implement a manual control that does that. Now, the second point is, can we get our systems to do that and enforce segregation of duties? what we see is a high number of systems that attempt to enforce segregation of duties and fail because the general IT control environment can't be set up in such a way, or there's other issues that don't allow us to be able to place reliance on that automated control. So almost the audit standards almost indicate the fact that we expect this, we don't expect anybody will ever be able to meet it, which means that we're left again in a sort of technical reporting point where we're constantly raising this recommendation. Now, 5-10 years ago, we would have been raising this as a recommendation. It would have continued to be an open recommendation year after year after year, and we don't think that helps anybody really. So what we do to ensure that we're meeting our reporting requirements is, in our detail of how we've addressed a significant risk, we bring it to the attention of the users and don't have it as a formal recommendation. Now, don't get me wrong, there's ways in which the control can be further improved so that the organisation does have assurance over those entries, and there's always a scope for continuous improvement, but to be able to get a clean message to say that we're happy with the design and implementation of that control would be very, very difficult and quite costly, I would say, in terms of how it would be set up within the system.
Thanks for that, James. That's really interesting. The reason I'm smiling is that when I was a works accountant 40 years ago, and we had manual ledgers, I had to sign all the journal vouchers, countersign them all, so they were approved before they went into the ledger by the relevant manager. But at the end of the month, I went through and signed it all off. And that was a standard audit question. How do you know the accounts are right? And the answer is because I've looked at all the journal vouchers. Now, that is quite, as you say, an onerous requirement. But in terms of, and we should be able to do it better nowadays with AI, that sort of thing that we've got. So in terms of the basic controls then, if someone raises a journal voucher, who approves it in the accounts? Is it someone in finance, or is it someone in a non-financial role?
So all the journals that are raised during the course of the year, it's restricted to finance officers to be able to do that. And then at the year end, so during the course of the year, there isn't a requirement, to to have that two-stage control. But come the year end, we look when year-end journals are being prepared, then there is then oversight of all the year-end journals that go in. So so once you get to sort of the end of period 12, anything beyond period 12, then there is sort of oversight and checks to make sure that the year-end journals are appropriately coded and got appropriate supporting evidence for them.
Could we get to where we need to be if we had a materiality threshold?
Whether it's low level or high level fraud. So I think we would expect the same process to be applied to all journals. Now there's organisations who have implemented a statistical check of 5% of journals each month to make sure that appropriate documentation has been added to the journal, follow-up, approval, that sort of stuff has been added, and that's something that internally an organisation can take on board. And I would sort of stress that actually that's the main purpose that you would look at this control in terms of assuring your management, assuring themselves and assuring the committee that robust controls are in place. In terms of satisfying us with regards to this control, like I say, I don't know if we would ever be satisfied, and I haven't seen an auditor be satisfied with regards to this in a long time. And therefore that's why we carry out additional substantive procedures over journals in terms of identifying unusual combinations, journals posted and approved by specific users, journals posted at year end, that type of thing. So we carry out extensive work over journals, and we really dig into the support and information, the reason for the journal. Whereas actually if we had assurance over the design and implementation, actually that work would reduce quite significantly. But rest assured that the assurance that we give you in this report is because of quite a lot of detailed analysis over the journal entries, where they're going, the value, who's posted them, who's reviewed them, and the supporting information that goes along beside them.
So my final point was the point on page 233 on the write-offs of loans to two companies totaling 5.2 million. I think there's a lot of discussion there about the arrangements and the lessons learned, and you know, but I just thought it's a big enough figure just to, you know, say we've noticed it, and do officers or auditors want to make any further comments on the issue?
I mean, from our point of view, yeah. I mean, it actually came up as part of our audit of the financial statements rather than through our value for money work specifically. And obviously at that stage, we wanted to understand whether there could be a significant risk with regards to the arrangements around these loans. And so we did a lot of detailed follow-up with management about the nature of the loans, what work went on through the course of the year. And I suppose where we got to was this, whilst the lessons learned are important, the arrangements in place, I think, are improving with regards to throughout the course of the year. The nature of the organisation and the fund, and it needs to contribute into the local economy to try to stimulate growth, is something that is probably not something you would see in all our organisations, and therefore I suppose the tightening of those controls around the security of those loans and the way that they're monitored going forward is probably important, but we didn't quite think that it met the bar of determining a significant weakness. It's slightly below our materiality. What was in place during the year and the awareness of the situation gave us enough comfort, but it is something it will be a specific point that we'll follow up on next year with regards to our own value for money work.
Thank you.
Are you trying to come in, Gareth?
Yeah, I just thought it might be useful just to provide a little bit of context. So the MCA has in the past supported high growth businesses that are aligned to our strategic objectives. We've either granted or financing support, and that's what's happened in this example. So when we received our devolution settlement back in 2020, one of the things we looked at was whether we had any businesses that were on the cusp of growth but couldn't deliver for many different reasons. One of those principal reasons is what we call access to finance, which is a bit of an issue within South Yorkshire. So we can show you graphs about the dearth of private finance that's going into companies within this region. If you want to get a business loan as a startup company or a growth company in this region, you tend to have to get on your toes and go down to London, speak to a capital finance in-house who doesn't particularly understand your circumstances, doesn't understand your economy, local economy and needs. And we've seen that as an inhibitor to growth. And we've done quite a lot over the last few years to try and address that situation. That includes stimulating private finance to come to the region in the first place. It's why we've got an agreement with South Yorkshire Pension Fund for them to develop a place-based impact fund to look at trying to invest our local money into the economy. But where we've got a shortfall, but we think we've got reasonably good bets, we have in the past looked to support them directly, and that's what happened. That sort of approach has landed us the likes of Boyle, McLaren in the past, AML, Accelerate. We've got a whole list of businesses who've done really well and who have grown within our region and employed lots of people. And we get catalytic agglomeration effects from that, where other businesses then come, it grows the supply chain. It's a good model, but now and then you got to be prepared to take a hit. So not every business that you invest into will grow in the manner that you would like. What we've seen with these two businesses is that they started their growth journey just at the point that Kwasi Kwarteng and Liz Truss launched their mini budget, and it tanked the economy. And that obviously saw quite a long spell of market turmoil that impacted on investor appetite, impacted on interest rates and so on. And they really suffered on the back of that. They weren't able to realise their order books in the way that they'd expected, weren't able to generate the private investment through equity or loan finance in the way that they'd expected. And then there were individual peculiar challenges, particularly with one of the businesses in terms of shareholder relationships. So these were good businesses that we thought were worth a bet. We put significant amounts of money into it. Unfortunately, they've not come off, and that's the nature of commercial investments. Not everything you will invest into will succeed, and you've got to accept that as a portfolio risk. So what we've done this year is write down those loans. They're not wholly dead in the water. There is opportunity to revive them, but we're doing the prudent thing and writing them off at this point. Just to give the committee some assurance about what we did about this. So we launched a sort of internal review just to make sure that our original decisions were sensible and we could assure ourselves that they were. But because of the nature of how we funded these through our gain share, they were also subject to review by the government's independent assessors as part of what we call the Gateway Review. The Gateway Review is an analysis by government's independent assessors about how we've used our gain share resource. So they looked into these, they checked our rationale for decision making, looked at the management of how we've contracted and how we've monitored, and we've just passed our Gateway Review. So you can gain some assurance that government checks have considered what we've done here, and they accept that we've made sensible use of our money. So it's not great, we don't want to be here, but unfortunately it's the nature of how we do business. You can't grow an economy without making some mistakes on the way through.
What lessons have we learned from this, and have we got any risk assessment mechanisms in place in terms of determining whether companies qualify for loans?
Yeah, so we have a really quite thorough assessment exercise through our assurance framework. We use independent assessors to look at every opportunity. I think there are some issues that we picked up. So in some circumstances, our investment was going in as a package of private investment. Sometimes you need to put your public funding in advance of private investment to allow that to flow. So you need to create the conditions for the private investment to follow on. In one specific circumstance, our public money went in ahead of a commitment to the private investment. That private investment never materialized at the back end because they changed their mind at the last minute. So we learned a lesson on that, which is we'll stick our money in at the same time, not before in this example. And we'll have to make sure that money's landed in the bank account physically before we put our money in. Now that's difficult to do. That could be a challenge to future investment. But the overall learning for us is that sometimes your investments don't come off, and that's not local circumstances. You can have the best business in the world that's on a growth trajectory that looks great, but if macro events at the national level, as we saw, or at a global level, as we saw during the pandemic, come along and disrupt your business model, you've got to accept that risk. So it's a difficult one for us. As I say, we don't want to be in this space, but ultimately, if you invest into businesses, it is not risk-free. If it was risk-free, public sector would not be involved. It would all be privately funded, but that's where we are.
Thank you, Chair. Just an observation on the last one, Gareth. You're absolutely right about getting the private sector investment in at the same time. And I'm sure lawyers can devise some contract that says that one is conditional on the other, so that you don't have to release it till it's needed. I've seen that done before. Can I just pick up a couple of points that we had in discussion generally at the start of this item? First of all, add my thanks to the team for what they've done and the audit team. I thought the audit reports to the committee were some of the clearest ones I've seen since I've been involved, and very easy to follow. And picking up a point Gareth made about can people understand this? I know it's the next item, I think 8C, which is your formal auditor's report on the authority. But I thought within I think it's pages 199 to 201. There's a really good explanation of where we are with local authority auditing in terms of why things are disclaimed. And when you look at the next report, 8C, the audit report, it just says the accounts are disclaimed. Is there any way we can have the appendices from the report to this committee attached to that second report so that you can refer back to that's what disclaimed means? Because I don't think the majority of Sheffield or South Yorkshire citizens reading this would understand what disclaimed means.
Yeah, so with regards to the actual audit opinion that goes in the financial statements, as you would imagine from a risk and compliance point of view, these things tend to be as sort of vanilla as possible in terms of, and have to meet audit and standard regulations, and there's various templates that have to be gone through from that point of view, and I think it provides a slight bit of indication that it's due to us not being able to obtain sufficient and appropriate audit evidence over opening balances and movements in reserves. So it doesn't really bring it to light. I suppose this report, our auditor's annual report, the one that we reference, that comes on later, what we can do is from the first report add these appendices to the auditor's annual report, because the auditor's annual report is the one that has to be published on your website alongside the financial statement. So actually the interpretation is if you were interested in looking into these sort of things, actually you might not pick up the financial statement, you'd probably look at our report that summarises our work. So it's actually a good point if we can bolt that onto the back, rather than bolt it onto the financial statements and the audit opinion, bolt it onto the one that's presented on the website. So happy to take that away, because I think you're probably right.
Thanks very much, that's great, thank you.
Okay. Any more points of discussion, questions? Okay. I think we've come to the point where we are asked to endorse the recommendations, and we're asked that members endorse the final version of the MCA's 23-24 annual statement of accounts and recommend that they be formally approved by MCA board on the 28th of January 2025. Do we so endorse?
Yes.
Yeah. No votes to the contrary. Thank you very much. Thank you. Stated early 8185 of the individual appendices to the item we've just approved. Unless there are further questions or comments, can I confirm that members note items 81 through to 85? Yeah. Thank you very much. That brings me to item 9. Recommendations. We consider the work plan and agree any changes and additions to the schedule.
Sorry, Chair, do we specifically need to note that you're going to be signing the letter of representation?
You can
That's
put that
something
forward.
Yeah, just as a...
Just a point of note in the representation, I do believe we're going through the final stages of our technical and risk review, and for a disclaimed audit point of view, I think there may be an additional bullet point within that representation to acknowledge the fact that it is a disclaimed audit. The representation letter that you see within this pack is a standard representation letter for an undisclaimed audit, so there probably will be an extra bullet point, but when we send that through beginning of next week, hopefully I'll highlight that additional representation. But it's not an additional representation, it's a standard representation point for a disclaimed audit is the point.
Right, so no items for the work plan. Any issues for escalation? Nope. Right, that brings me to the end of my agenda. Thank you very much.